The number one question I get asked almost on a daily basis is, can you pencil a deal right now with rates being higher, inventory being lower, and prices of real estate still inflated? Maybe you've read the book, The Diamond Wealth Real Estate System. You like it, but you don't know if you can implement in this environment. The best way I can answer it is just to show you, take you behind the scenes, behind one of my deals that I just finalized just a couple months ago. And it's recent, it's from 23, and it's with the current rate environment. It's not even, the example's not even in the book because it literally just happened. So what I did, this one is just right off the MLS. Look at this beauty. It is a brick home. Hit the market. I saw 209. What a deal. Most people see this and they run. I see this and I see money. I love it. Everything about it. The flooring is amazing. You don't have to change it. It's already tile. That's built to last. Kitchen is nice. This is what it looks like after. As you can tell, I leave the flooring the same. I don't change it. There's no money in it for our purposes. So this is what it looks like. And this is how we buy it, the settlement statement. Now, if you've read the book, you understand the diamond cost range and how we come up with the initial loan amount, which is 245 diamond cost range. And I go through the whole process in the book, the Diamond Wealth Real Estate System, so you understand this better, how I'm coming up with these numbers. 1,000 is just the earnest, and then we have a little commission credits. I always like the credits to be as a never as a commission if you get them, because it's taxable. So I like it a credit against the price. And you can see on the bottom, refund due buyer 41,443. We're getting paid to buy real estate. It is absolutely amazing. So let's take a look and see what the actual numbers look like. This is the purchase price, 209. Our initial loan amount, 245. Again, you have to understand diamond cost range, and you will understand better as to how I came up with 245, and it's all in the book. Cash back at close, commission credit, some closing costs. So we're looking at 40,443 to buy a real estate. Absolutely amazing. Beats the traditional model where you have to put 25% down. So we're getting paid 40,000 on the front end to buy it. The out-of-pocket expenses, rehab was 65. Now on the rehab, I could have gone lower, maybe down to 40, even a little less. I chose not to. I want to make it nicer and make it where it can last for hopefully a few years, issue free. So I went a little nicer, 65, and I'm okay with it. A little some interest while I was being rehabbed and some miscellaneous. So we're looking at 72,425 auto expense. Now, when you subtract what we got back at close, the out of pocket on this one is 32,000. Not bad for this deal. Not bad at all. If you compare it with a traditional purchase model, and you bought it, same deal, you bought it from the MLS 209, you'll have to put down 25%. Everything else stays the same. So you're looking at 125 out of pocket versus 32. So it's a lot better. And the traditional model is a lot harder to scale. Now, if you have unlimited funding, something like that, that's fine. But it's tougher to scale. And I like to minimize the out of pocket expense or eliminate on the front end. So this is the out of pocket. Interest only, it's at 8%. There's no principal pay down. Right now, the rates, it doesn't make sense. I like to maximize the cash flow. So it's interest only, 8% for now, 1633. Tax and insurance, 150. And you're looking at a total monthly holding cost of 1783. The rent I'm getting is 3,000. Monthly cash flow is 1217. Now, I am a little more flexible with the tenants. I do allow them to run sometimes a business from it. It yields a little higher on the rents. If you don't have the tolerance, or it's one of your first one, you're like, hey, I just want to rent to a normal tenant, you'll be looking at 2,500, and you're still getting 27%. I mean, even at 2,400 per month, you're getting at 23. I'm going to leave this at 3,000 because that's what it is. So it's 1,200 bucks on this one. Not bad. 45% cash on cash return. Pretty good. There's no other vehicle like it that you have so much control over and yield such results. Now, the post rehab value is 345. Not bad. When we got it for 209, our loan is 245. Clearly, we did some improvements to it to get the 345. And the equity, once you back out what we have into it, just pure equity minus our cash, 68,000. Pretty good. Again, I'm not going to see it. You don't want to sell. Rule number one is you never sell. It's going to blow up the whole deal. You're going to pay taxes, capital gains. Always 1031 exchange or cash out refi if you want to tap into the funds. You buy and hold or 1031 in perpetuity. So this is great. 212%. Again, no other vehicle like it. And so what we've done is we've minimized the out of pocket to get in the deal. We've maximized the cash on cash return, and we have maximized the equity on day one. And I know a lot of other people are saying you can buy real estate with negative cash just to build the equity on the back end. While that might sound great, it doesn't sound great to me. I like cash flow. I think cash flow is king. And unless you have another business that's performing at a very high level, it allows you to absorb the negative cash. Buying for negative cash, it's very, very difficult to scale. I mean, even if you're losing 500 bucks a house, 10 houses, you're losing, thousands, not to mention the expenses. So I believe cash flow is king, and I like to do the three things: minimize out of pocket, maximize cash flow, and maximize equity day one. Real estate deals are made on the purchase. So remember that when next time you're doing it. This is just a 5.5% annual appreciation. Assumption you're looking at what potentially could be worth at just 5.5 annual, year 5, 450, 901. Assuming we didn't refi, we didn't take any more cash out, no principal pay down. Let's pay the 245. So you're looking at 205,000 in 5 years on this asset. Now, by then, you would have paid back your initial out-of-pocket cost of 32. So it is literally infinite returns at that point. And when you get here, if the cash flow to equity is not penciling, again, you can either cash out, refi it, or 1031. And my preferred number is into 3 houses. That's the magic number. So you do 1031 and you repeat the process 3 more. So you take 1 into 3. Never pay tax unless you sell, which is the crazy idea. Never sell your real estate. So this is this is how we do it. Now, to answer the question, can you pencil it? If you can identify them, know the system, you understand how to structure the deal, absolutely, in this environment, you can still pencil them.